I would be surprised if, I'd be surprised if silver went sideways. It could. I don't know. No one does. Again, I could be wrong, but I think we're not done. And it may take 6 weeks or so, 4 weeks to consolidate and start up again and get back into triple digit. If it were to go a year, I would probably start reevaluating my premise at the whole way. I'd be thinking about it, but I probably wouldn't put anything out to my membership until, 3 months have gone by and say, look, here's what's happening. The Shanghai Exchange has got all the silver. It's not moving. London's got all the silver. It's not moving. The COMEX, their silver supply, all that silver that went in finers in 100-ounce bars is now 1,000-ounce bars. The market doesn't want it. It's being stockpiled by the bullion banks into those 3 locations. And I guess I've been really doubt that's the case, but I cannot rule out all possibilities.
Silver market volatility remains a central focus for analysts like David Morgan, who believe consolidation may be temporary before another potential breakout. While silver could trade sideways for several weeks, expectations of triple-digit prices persist if structural supply deficits continue. Observers are closely watching inventories at the COMEX, the Shanghai Futures Exchange, and the London Bullion Market Association. If silver were heavily stockpiled without demand pressure, bullish forecasts might require reassessment. However, tightening physical supply, refining shifts from 100-ounce to 1,000-ounce bars, and persistent industrial demand continue supporting a strong long-term outlook. Now, we present the clips from David Morgan's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
In 2025 for gold, silver, platinum, and palladium. All 4 moving together is confirmation of a major bull market. We saw silver and platinum actually lag up until April or so of 2025, and then they took off and exceeded gold's move rather substantially. So both platinum and silver were up 140%. Silver went what I would call double parabolic in January, up almost 70%. But that was scary. Not that I don't like to see it, and my account looked pretty good, but you don't count your chickens until they're hatched. And I was warning everyone, public and private, my private work as well as interviews like this, that it's going to come down. And it's probably going to come down hard. And it did. And of course, many people are mistakenly saying that this was the largest one-day sell-off in the silver market ever. Not. If you go back into history, and I was there, I was young enough man at the time, so my age now. Point is, Silver Thursday, March 27, 1980, silver went from over almost $21 to about 10. So it was like a 5-cent cut rather than a 30. Nonetheless, that big move from like the 120, 124, whatever the top tick was, down to 7, that definitely shook out the market. But that's to be expected, unfortunately, especially when you get an acceleration. What's ironic about it, Vlad, is if you took the first day, 2026, I think it was the 2nd of January, and the day of the 30th, where it ended at, I think, 78. The market for January was still up 10% for the month, which is crazy. Because if I had told you ahead of time, hey, look, Vlad, I'm going to end January with another 10% gain silver price. Oh, wow, great. But since it really just went, rocketed up. So there's point number 2. Point number 3, probably as important as point number 1. We are in a situation, we meaning precious metals invest, or the silver market, you can think of it in those, is in a new dynamic. The new dynamic is price discovery based upon physical demand. And that's what's been driving the price for the last several months, up until we saw this big sell-off on January 30, where the paper paradigm took over control of the market, and I'll put in quotation marks, temporary. So now we're kind of in a battle between physical demand for silver on the commercial bar side versus the paper quantities on the commercial bar. And right now, the paper people are winning. And I think that's going to go back and forth. The only caveat is I could be wrong. I doubt it. But we could be in a situation where the physical demand for hard metal commercial bars has been satisfied temporarily. So for an example, Vlad, let's just say that Samsung, 3M, Tesla have all got their hands on enough physical silver to satisfy their personal demand for industry for the next 6 months, 6 years, whatever their timeline is, and they don't want to buy anything. They've got it locked in, and that demand is gone away. Now, I really, really doubt that, but if that is the case, then we're going to have to rest a while before that demand back. Now, that doesn't negate investment, which could take over and continue this bull market based on physical supply, but it might not, because most of the investment demand is price-based, meaning I'm only going to buy silver when it does. And there's all kinds of algorithms out there, but until it gets above the 10-day moving average, 20-day moving average, converted by the 10-day moving average, and the volume is at this level, then we'll go. I want to get 210. Overall, I'm still bullish. I think we've done enough damage, or if you want to call it damage if you're long, to have to rest a while, probably establish a trading range, and then determine if the physical market, as I just said, is gaining control again, and we start marketing.
In 2025, gold, silver, platinum, and palladium surged together, confirming a powerful new precious metals bull market. Silver and platinum initially lagged gold before exploding higher, with both gaining nearly 140% for the year. Silver's double-parabolic rise in January 2026 triggered a sharp correction, echoing historic volatility like Silver Thursday in 1980. Analysts now describe a new market dynamic: physical demand versus paper selling pressure. Industrial buyers and investors are shaping price discovery more than ever. While short-term consolidation is possible, tightening supply, strong commercial bar demand, and renewed investor interest suggest the long-term bullish trend for silver and precious metals remains firmly intact. Let's get back to the interview.
Well, if you look at a 25-year bull market, 10% is 2.5 years. Gold broke out at around the 2000 level. So we might have a year and a half left basis that metric. Well, what happens next? So we'll peak in a parabolic function like we just did in silver. Some people are saying that is it. That's the move, and you missed it. I don't think so, but I'm not 100%, especially basis the gold trade. Anyway, what does happen? Well, what's occurred in almost all cases that I'm aware is that it peaks in a parabolic move. Some very few get out the top. The market starts down and then it corrects down. So it gets overbought, overextended, and really overvalued. And when it's overvalued, overbought, and overextended, it has to correct. And it comes back to being fair price. And then it establishes a range at the fair price level. And you see people that are disappointed. They missed the top, but it's still much higher than it was from the breakout, like you just outlined. That's what normally happens. Now in silver, the last time we got it overbought, overextended in a major way was in 1980. It happened again in 2011. In both cases, it dropped. In 2011, it dropped to a new high, $30 range, stayed there for about a year, and then it folded and came way down. I think this time it'll act more like gold, what I just outlined. It'll drop and establish a new fair value price. I don't think it will do what it did in 90 or 2011, where it really crashes over. First of all, the cost to mine it will be higher. At that time, I expect oil costs or oil price to be substantially greater. And lastly, this industrial demand is like 65% of the market. So I do think we'll see a reestablishment of quote unquote fairly valued gold and silver. Apple 20% at $80 silver, 20% at $90 silver, 20% above 100. Hold 20% in case we go into a hyperinflation. And then on the way down, if we establish a 10-day average trading below this level, then sell more. Because the last thing you want to do is go from 50 to 120 and back to 50. If you got in at 50 and ride it all the way up and all the way. So this guideline gives them. So I had 3 or 4. I'm sure it was more than that, because usually every email you get is like there's 10 people behind it with the same question. That's a rule of thumb, not an exact number. But I had about 4 that got out, and they got out in the 100. And it was very difficult to get out at that real price because most dealers were bidding back $15, $20, $25. But I interact with a hedge fund manager friend of mine that gives really fair prices on the spread. Very low on the buy side and very low on the sell side. In other words, you're getting the best price by buying and you're getting the best price by. And I guide all of my members and some use them, some don't. I'd say at least 90% of our membership uses them. And so they were able to escape that huge delta, that huge huge difference between the spot price on your computer versus what they were actually. So that made me pretty happy because I want people best price going buying in. So that's something to note. Other than that, no. What did I do? Really nothing. I was going to lighten up on not just the silver but my platinum. I did not. Stock wise, yes, but my stock portfolio is not even 50% of my overall holdout. And I'm long term. I think most of the stocks did get, maybe I wouldn't say overvalued per se, but they made a nice run. And so I did take a little bit of profit there, but that wasn't at the time. It was prior to that. A friend of mine that's a very good stock analyst that works for me suggested maybe taking a little bit off the table. And at the time I thought, yeah, why not? We did.
A 25-year precious metals bull market suggests gold and silver may still have upside before a final parabolic peak. After breaking above $2,000, gold signaled a long-term breakout, with analysts projecting a potential blow-off top followed by a healthy correction. Historically, silver's extreme moves in 1980 and 2011 led to sharp declines. But today's environment differs due to higher mining costs, rising energy prices, and strong industrial demand representing roughly 65% of usage. Experts believe future pullbacks may establish a new fair value range rather than collapse. Strategic profit-taking, disciplined allocation, and understanding physical versus spot pricing spreads remain essential in managing volatility. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.